following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared on the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it is Saturday, and we're going to be talking about money. So much to cover. This year is unrolling very well. We have begun to put the pandemic behind us, and I can't say that we're looking forward to the next black swan, but we know that there will be one coming up. How soon? In a year, 2 years, 5 years, 10 years, who knows how long. But it is a time to prepare for the next black swan as we come out of this one. It's been a good year. 2020 was a very good year. 2021 is off and going. So let's talk about some of the things that are going on. We're going to talk about that. We're going to talk about the long-term strategy, the mile-high view. I'm revisiting that. Now we're revisiting the post-pandemic world. It's time to talk again about the mile-high view and talk about what's going on in total. But first, I want to let you know I am again speaking at the Money Show. There are a series of at least 6 presentations I'm making over the year, over 2021, and there could be several more. So you can Google the Money Show. You can see when the next time I'm speaking is, and you'll see there's some lesser-known speakers, but you'll see people talking about alternative investments, about day-to-day trading, day trading, rapid trading. See people talking about commodities and estate planning. You'll see other people talk about their methods for investing in stocks and some in bonds. You'll see some estate attorneys. You'll see some people talking about IRAs and some of the other things. Some people talk about life settlements and some about structured products, and you know what I think about a lot of that. But for me, I talk about my specific program, what I'm doing, and how it is working. So come hear me talk. It's for accredited investors. Most of the presentations are for accredited investors, but there will be some for non-accredited investors. Accredited investors, of course, are people that have $1 million in investable assets. So do come and hear me talk. Hear what I have to say. So I worked, and as we talk about that, it recalled an experience I had back between the time I graduated from Oregon State with my degree in math and went to Carnegie Mellon for my MBA. Back in that summer, I worked a summer for Pacific Gas and Electric in San Francisco, and I worked in the Operations Research Department. It was a very, very important department because it was about forecasting electrical demand into the future. And if you build too many facilities too soon, you end up borrowing money to buy those facilities, and you end up paying a lot of interest without any revenue coming in for years. If you don't build soon enough, you end up with brownouts and not being able to furnish enough electricity. So the way that it usually worked, and it had worked for decades, is the Operations Research Department, or the Forecasting Department is what they called it. The Forecasting Department would take out the book from the previous year, count the number of dividers in the book, count out new dividers equal to the number of old dividers and put those into a book, and then begin to update what had gone on. But with computers and the advent of operations research, they began to look at other forecasting techniques. They began to look at smooth moving averages. They began to look at just moving averages, period, but also smoothing those moving averages. Also looked at linear regression models. Linear regression is a mathematical model where you begin to look at the relationship between two variables. you look at how temperature affects ice cream consumption, for example, and you find that as the summer comes along, ice cream consumption goes up. Not a big surprise, is it? But you find out that it's not absolutely correlated because some people continue to eat ice cream during the wintertime. So it's not a 100% thing. So you end up with a correlation coefficient. How well does the temperature predict ice cream consumption? You can do it with heights of people. You can do it with any number of things. And that was the focus, to begin to do linear regression, to look at variables and look at everything we could to predict what electrical demand would be in Northern California going forward. And we found out one that was 97% perfect. 97% fit. We thought, this is really the very best fit we found. The very best. 97% accurate. And that variable was the number of prisoners on Alcatraz. Now, we'd thrown everything into the equation. We were playing with the whole thing. We were seeing how it was going to work and see how predictive it was. The number of prisoners on Alcatraz was the best forecast for electrical consumption going into the future. Now, if that had really held, like the temperature and ice cream consumption, if that really held, today there would be no electrical consumption in Northern California. So I learned a great lesson from that. I learned a lesson that it's not just having a correlation that matters, it's finding the underlying reason that there is a correlation. It's easy to see with ice cream and summer temperature. As the temperature goes up, more people eat ice cream. As the temperature goes down, fewer people eat ice cream. You can understand why that happens. But in the case of the number of prisoners on Alcatraz, there's no relation between the number of prisoners on Alcatraz and electrical consumption in Northern California. And I tell this story because I see again and again and again people talking about asset allocation or predictions about the stock market, predictions that are based on data that have been collected. And I think of the time, I've mentioned this a number of times, about the game or the study where people were brought in and a coin was flipped and it comes up heads, it comes up heads, it comes up heads, it comes up tails, comes up tails, comes up tails. That's a pattern. And people begin to see patterns where they really don't exist. If you continue to flip the head the next 3 times, it's probably not going to come up heads, 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 and then tail, tail, tails. That's a pattern that just happened to be, and it will happen once out of every 64 times you flip the coins. 63 times, it's not going to happen. But people begin to see patterns. People begin to see patterns in the relationship between real estate and stocks and commodities and different commodities. They see those kind of patterns, and they begin to think there's a relationship between those. And there probably is some relationship, but it's probably a pretty weak relationship. They take historical data and they look at the correlation efficient, how really connected are the two variables. And in historical data, they find there's not very much connection between commodities and stocks. There's some inverse connection between real estate and stocks. When real estate is hot, stocks are cold, and when stocks are hot, real estate's cold. You can find some of those patterns, just like you can find the head, 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 tail, tail, tail pattern. But there is some validity to it. But the fact is, not a great deal of validity. And what the Great Recession taught us, going back to the Great Recession times, is those correlations do not hold up. And what it means, when you have those correlations, when you're doing asset allocation, trying to reduce volatility, and in the short term, it really does reduce volatility. You keep your volatility down so that when one asset class goes down and another goes up, there is some relationship there. But what you're giving up when you do that, you're giving up upside. And I used the example. If stocks are up 10%, bonds are up 3%, and cash is up 1%, by splitting your portfolio into those, you will end up with less volatility, but you will also end up with lower returns. And you can cut the returns very, very significantly. A difference between 5 and 10% is tenfold. A difference between 5 and 15 is 100-fold. It makes a very huge difference. So those correlations which hold up on the short term is not really what you want to happen. You want them to hold up in the long term. It didn't during the Great Recession. It didn't at all. It was a tremendous mistake. It was misleading information, and a lot of people got hurt by it. If you look at the data, you don't want to be hurt by looking at those correlations. Anyway, we're coming to a commercial break. When we come back, I want to talk about what's going on worldwide, because it will have an effect U.S.-wise. Don't go away.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
Okay, so if you look at the Standard & Poor's, I want to talk about the Standard & Poor's. I want to talk about worldwide situation. If you look at the Standard & Poor's, over half of the companies, of the companies in the Standard & Poor's 500, let me say it the correct way. Of the companies in the Standard & Poor's 500, over half of their revenues are coming from overseas. So you really have to think about what's going on in the world to understand what's going on with the companies in the U.S. And I've been talking since 2012, since February 2012, about a mile-high view of what's happening in the world. Now that we're going through the pandemic, or are on the opposite side of the pandemic, it's coming down and going away, and it will take a couple of years before the full impact is over with. We're probably going to see it into 2022 and 23. We're going to see some of the impact. And we could see some of the impact going up as long as 6 years, but we can see an end to it now. And we can see that it's coming to an end. And the world is changing. But one thing that is still going on is the super cycle. I've talked about this again and again, but it's important to understand and not lose sight of. Let me remind you what it is. Standard Chartered Bank of the UK, 1,700 branches, 80,000 employees. They did a report on times in our history, worldwide history, when GDP growth was higher than average. And those were long periods of time. The first supercycle from 1870 to 1913, 43 years long, it was driven by the industrialization of the United States. In the 1800s, mid-1800s, the United States was an agricultural nation. 80% or 90% of our exports were cotton. Just think about that. The 90% of the U.S. millionaires lived along the Mississippi River because they were farming cotton. That was prior to the first supercycle, but we had a downturn. We had a downturn that no one rescued us from. Actually, we had a first depression related to cotton back in the 1838 and 1848 time period. But in 1873, we had another one. But in 1870, we began to see a change take place. From 1870 to 1913, the United States really began to change in terms of becoming an industrialization nation. Agricultural, 50% of the people had been working on the farms. That really reduced dramatically during that time period. And we saw a powerful growth, but difficult business cycles during that period of time. That was a period of time which saw the United States, not only did we become industrialized, we became the world leader. London had been the world's financial capital. The British Empire, they talked about the sun never sets on the British Empire. That power began to roll back and roll into the United States. We became the world power. That was the first super cycle. Second super cycle, 1945 to 1970, 35 years long. It was driven primarily by the reconstruction of Europe, by Asian exports, by the decolonization. Many of those European countries had colonies in Africa and Asia. It was a period of time in which those colonies became independent countries. Business cycles are relatively benign. The growth in the wealthy countries, in the U.S. and the U.K. and France and Germany, was considerable. And during that period of time, if you look at the stock market, it went from 100 or 150, depending upon the year you look at, to over 1,000. And that was the time of the Cold War. But that was the time, 1945 to 1970. Think about the U.S. We built the interstate highway system. The GIs returned from the war, and we had a housing boom. We built airports. We began to build the infrastructure around the United States. All of that was happening during that time period. And technology exploded as well. The third super cycle, the one we need to talk about now, began in 2009. As we were coming out of the Great Recession, a new super cycle began. And this time, it is being driven by the emerging nations. Some of those were colonies before, but it's being driven by the countries like China and Brazil and Indonesia and Russia and Turkey and sub-Saharan Africa. A time in which there's big political risk, when there's social volatility. You look at what's gone on in the Arab countries, you look at what's going on in the world. It's a time of great volatility. The estimates are that by the year 2030, and we're within 10 years of that, by the year 2030, 93% of the world's middle class will be in those emerging nations. I tell the story, and I'll tell it again, about a client that I had at one time who was the plant manager for American Standard in Tianjin, China. He was transferred as an American, went to Tianjin, China, and started this plant, had 1,000 employees. They were manufacturing ceramic toilets, ceramic bathtubs, ceramic shower stalls, but not one of those 1,000 employees had ever seen, let alone used, a ceramic toilet, a ceramic bathtub, or ceramic shower stall. Now, those 1,000 employees, they have smartphones, they're driving cars, they buy lattes, they buy their food in a grocery store instead of growing it themselves. They buy their clothes from department stores instead of sewing and making their clothes themselves. Back at the time that plant started, they were subsistence. They were going hand to mouth. They were growing their own food. They were sewing their own clothes. They were living at a subsistence level. Now they're consumers. Now, not consuming perhaps as much as consumers in the U.S., but they are consuming. And that means they're buying American products. In addition to Chinese, in addition to French, in addition to South African, all those things are going on. A month or so ago, Ben Chang was on the program. He talked about exporting Washington wine into China. That's happened since China has made that jump from subsistence to commercialism. And there's now more middle-class people in China than the population of the U.S. We're seeing that growth all around the world. And those are people that are consuming American products. And that's where the growth of S&P 500 companies is coming from. A good portion of that is understanding that that growth is coming from there. So the question is, Why not invest in those countries then? But before we get to that, I want to talk about why the supercycle. Why does growth suddenly accelerate during those times? And I want to go back again and talk about the first supercycle, before the first supercycle. In 1820, 94% of the world's population, including the U.S., was living on an average of $19 per month. In today's terms, $228 per year. Think about it. You probably make more than that in 1 week today. And they were living maybe 1 day, maybe 1 hour. And they were living on that in an entire year. Life expectancy was 37 years. People were living on the farms. They were raising their own food. They were making their own clothes. In fact, shoes that were made, and shoes were not made by individuals. John Adams, president, the third president of the U.S., second president of the U.S., manufactured shoes. And if you look at the shoes, the same shoe fit either right or left foot and fit all different sizes. One size fits all. Right or left, long or short, didn't matter. That was the way shoes were made. By 1870, the beginning of the first supercycle, 87% of the world's population was living in poverty. So already there had been a change from 94 to 87%. Half the population still lived on farms or in towns of fewer than 2,500 people. U.S. labor cost, U.S. labor, people were earning $292 per month in today's dollars. And now they were beginning to make some changes in some of the things we ate, although they were still eating chicken stew and dumplings and mashed potatoes and biscuits with honey, no salads. Life expectancy had increased from 37 to 44 years. They had dealt with smallpox and cholera, tuberculosis and yellow fever. And the medical kits consisted of a black bag with saws and knives for amputation. That's what most doctors did. By the end of the first cycle in 1915, the rest of the world was at 82%, but 1 out of 5 people in the U.S. was living on the farm. 4 out of 5 had moved to the cities, and were earning $1,341, an equivalent of $8 per hour, coming up almost fivefold, more than fivefold from what it had been at the beginning of the supercycle. Shoes were now made in factories and were for right and left feet and fit. Food varied. Life expectancy reached 53 years from 44. Significant change. Worldwide, still 82% poverty, still a lot of subsistence, not a lot of consumers. But that was the end of the first supercycle. By the beginning of the supercycle, the world was 73%, but had already begun to see a decline and the rebuilding of Europe. But the big decline in worldwide poverty began in 1960, and today it's just over 20%, still a large number. And through the pandemic, it's grown. 20% is before the pandemic. It's still grown. But there is a time in which people are still rolling along. So hang with me. We're coming to a commercial break. I want to come back and talk about internationally and investing internationally. Got a lot to cover. Don't go away. I'll be right back after this commercial break.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So I've been talking about the supercycle and going into a lot of detail with the supercycle because it's important to understand as we end this time of the pandemic that the supercycle is still intact. The things which are driving the emerging nations, the emergence from poverty, yes, the pandemic pushed people into poverty more, But as we come out of the pandemic, and it will take years to come out completely, but as we come out of the pandemic, we're returning to a time in which poverty will again begin to shrink, and worldwide, maybe it won't be 2030, maybe it'll be 2031 or 2032 before 93% of the world's population becomes middle class, but we're moving that way. So the big question is, if the high growth is overseas, and certainly that's true. 30 years ago, the United States was 50% of the world GDP. Today we're at 25. The rest of the world is catching up, and their GDPs are growing faster than in the U.S. We're taking advantage of that with our companies here who are selling overseas. But then the question becomes, why not overseas? There was a large brokerage firm, Goldman Sachs, in 2001 that produced a report on the basis of that. It was called the BRIC, and you've heard this, the BRIC countries, Brazil, Russia, India, and China. Those countries have explosive economic growth compared to the rest of the world, 6, 7, 10%. The idea is that is the place to invest because those are the areas to invest. The problem is the thesis was backed by GDP, but GDP is not necessarily stock market performance. Think about the U.S. Even though we've had a relatively low growth since 2009, our growth has been 2.5%. The actual stock market has grown from 6,600 to 31,000. It's been very significant, over 30,000 during that period of time. So beyond that, CS versus Boston, Credit Suisse versus Boston, looked at what was going on in the study, and they found that the numbers that Goldman Sachs used were really not correct. They looked at 83 countries from 1972 to 2009, and they ranked them for GDP growth for periods of the preceding 5 years. And they compared that to the stock market during that period of time. And what they found is investing in the highest growth countries, would yield an average of 18.4% a year. Investing in the lowest growth countries yielded 25.1%. The Goldman Sachs BRIC thesis doesn't really hold up. But I'll come back to that. I want to talk about and tell you about where I started my professional career. Once I graduated from Carnegie Mellon with my MBA, I went to work for Intaco aluminum smelter, and it was half French-owned. And my wife and I were sent to France to look at a research lab, to work in the research lab, to live there, and to experience what goes on. Because aluminum was discovered in the U.S. by the man of Charles Martin Hall, and at the same time by a man in France by the name of Paul Arouet. And so the aluminum industry grew up in the United States. It also grew up in France. And the country of France is one of the leaders in aluminum, just as the United States became a leader in aluminum. And I went to France soon after working there. And soon after, we were married. And what I learned is looking at the French system and how it operated. When you look at the education levels, children begin just like they do here at 5 or 6 years old. But at 12, there's a first separation. At 12 years old, you have the first test. And the people that don't pass that test, you see kids that are 12 years old riding in garbage trucks or sweeping up hair in hair salons. Their life is now set because they're not going on. They're going to become tradespeople. If at 18, the kids take another test called the back test, and that determines who goes to college and which college they go to. If you don't go to college, you can go to work in an aluminum smelter, for example, and you can be promoted to a foreman, you can be promoted to a general foreman, and then there's a glass ceiling. If you start as a worker, you never pass that glass ceiling. You never become a superintendent, for example. On the other hand, if you go to one of the top 3 schools in France, and the top schools are Polytechnique, École de Mines, and Santal, they're all 3 engineering schools. And if you go to one of those and you graduate in the bottom 3/4 of your class, you go to work, you parachute in, and you parachute into an assistant job, assistant superintendent. You parachute above that glass ceiling for the other workers, and eventually you become a superintendent, and you can begin to work your way up, and you can work almost to top management. But there's once again a glass ceiling, and you can't become top management. That's reserved for the top 1/4 of the graduates from those classes. They don't go to work for business. They go to work for the government for 20 years. And after 20 years or so, they parachute into the top positions in those companies. So that was the French system. And so the company that I worked for, Pecheny Aluminum, what happened is during the 1990s, during the difficult times, the French government decided to nationalize Pecheny. It just became part of the government. Do you think there were any protests? No. Did the top management resist? No. They knew all the people in the government. They'd all worked together. It was the shareholders that lost. 20 years later, 15 to 20 years later, looking at what happened, once again, the government is struggling with deficits, and what they decide to do is privatize, sell stock and Pecheny back to the public. So number one, they end up with selling it back to the public, and it becomes a public corporation again. That was the French system. And that country is very similar to the U.S. There's a lot of countries where the similarities are much, much less. They're not very great at all. Where if you look at what China and what they control, how they control their industries, or Vietnam, or some of the African countries, or some of the Eastern European countries, the control over the companies and what they can do is very, very, very liberal in what they can do. And so for me, I stick with U.S. companies. I know what goes on here. We see the controls, and we see the laws that are passed. We see the control that the countries have to fall under. We see the regulations. Much better here. And investing here, you get exposure to overseas and the growth overseas. Over half the revenues from the S&P 500 companies is coming from overseas. So you get international diversification without having to invest in international companies. But that is an area in which the world is growing faster and will continue to grow faster. The pandemic slowed the process down. It will change things. The pandemic will make a lot of changes in lifestyles, in technology, in demographics. Those things are going to change. They changed after the Great Recession. They changed after the dot-com. They changed after the build-out of the infrastructure in the 60s and 70s. Those things happen, and they change lifestyles. They change what's going on. And we will again see those kind of changes taking place. But the mile-high view is that the growth is coming from overseas, and there's a way to participate by investing in U.S. companies. Don't lose sight of that. Keep that in sight. Keep focused on the U.S. companies, because there's much greater control, much greater consistency, much greater transparency, less risk, less political risk, less stability risk, less government risk, less business risk by investing in U.S. companies. That's my take. That's where I'm going. And that's the big overview, the mile-high view of where we're headed. But then, it's not going to continue forever. There's going to be a time when that growth begins to slow down and maybe stop. When that happens, how does that come to an end? And why does it come to an end? And how can you prepare for it? We're coming to a commercial break, so don't go away. And after we come back from the commercial break, I want to talk about that period of time. I've talked about it before. I'll continue to talk about it, continue to talk about it, because it's really important, and it's important to prepare now for it. If you wait until you're in the midst, you're just not going to beat it. So stay with me. After the commercial break, we're going to come back and talk about how is this going to end? What's going to happen? And when it does end, where should you be? We're coming to a commercial break. Don't go away. I'll be right back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So I've been talking about the mile-high view of what's happening, and I talked about the supercycle. I try to talk about it once every 3 months because I think it's important to keep in mind. And even though we've gone through a pandemic and that's changed some of the things, and it would change things in terms of technology and demographics and lifestyles, still the supercycle holds true. There's every reason to believe that it's going to continue to happen. So the focus is on that. And it's probably going to continue. Standard Chartered Bank said it was going to continue through 2030. With the pandemic, it could go into the early 2030s. It could happen in another 10 or 12 years, but eventually it's going to come to an end. And it may not be, we may see some other black swans that extend it. We could see some things that happen between now and then that slow the process down, but eventually it's going to come to an end. My parents grew up during the Great Depression. And as my parents' generation came to power, they would do anything to avoid a Great Depression, including inflating their way out. My generation began to grow up during the Great Recession, a great inflationary period at the time of the 1970s, and the baby boomers grew up during that time. If you're born in 1960, you probably don't even remember that. After 1960, probably don't remember much about that. But those of us that were born before then remember the inflationary period, the stagflation period. And those, as my generation came to power, we would do anything to avoid an inflationary period. All sorts of inflation targets and limits to inflation. We're willing to risk a Great Depression to keep from going into inflation. My guess is that the generation that grew up during the Great Recession, as they come into power, and they're beginning to come into power, they're going to be willing to do anything to avoid another Great Recession, including initiating and allowing to happen a great inflationary time period. And if you look, a lot of people look back and think the inflation period started in 1972 with OPEC raising oil prices. Actually, when you look at it, it really began in 1963. Inflation was running at about 1% in 1962 and 1961. 1963, it got to 1.3. By 65, 1.6. By 66, 2.9. By 68, it was 4.2. By 70, it was 5.7. And by 73, after the oil crisis, it was still 6.2. By 75, it was 9. By 79, it was 11. By 81, it was beginning to decline from 1980, where it was 13% inflation. It was tough. If you lived through the Great Recession, you remember what it felt like. It's one thing to read about these incidents in books. It's another to experience it. It's one thing to read about the Great Depression. It's another to experience it in a Great Recession. It's one thing to read about the stagflation period of time of the 1970s. It's another to have lived through it, have seen what it means to buy a house and pay a 13% mortgage or a 9.5% mortgage, to see the business slowing down and shutting down. We've gone through a pandemic where businesses shut down. A lot of that was going on during the inflationary period. So what happened during that time? So in 1951, William McChesney Martin was appointed to be the head of the Federal Reserve. Truman appointed him, Eisenhower, and then Kennedy and Johnson, and Nixon reappointed him. He had gone to Yale, studied English and Latin, not a finance major, but he went to work for A.G. Edwards as a stockbroker, bought a seat on the New York Stock Exchange in 1931, and lived through that Great Depression. And Martin, having lived through the Great Recession, began to see, as chairman of the Federal Reserve, he began to see that period of time in the 1960s with inflation picking up. And he began to raise interest rates to slow the rate of inflation. But at the same time, as he raised interest rates, the country began to fall into a recession. During that period of time, Richard Nixon is elected president of the United States, and he's seen a recession take place, and he's seen the Federal Reserve raise interest rates to fight inflation. And when you raise interest rates, that tends to push even harder on the economy and the GDP to go down, and so the recession was getting worse. At the same time, Martin was continuing to raise interest rates, and Nixon, worried about being reelected for a second term, decided instead of reappointing Martin, he would appoint Arthur Burns. Burns had graduated from Columbia. He taught at Rutgers from 27 to 1944. He lived through the Great Depression, but his expertise was in business cycles, and he had a reputation of being influenced by politics. And so when Burns came into power, instead of continuing to raise interest rates, he took the opposite course to try to cure the recession. Having lived through the Great Depression, he was worried about tumbling into a Great Depression. So he began to lower interest rates. And as he lowered interest rates, the recession continued, and so did inflation. And we ended up with a period of time that's called stagflation. It wasn't until Paul Volcker came along. Paul Volcker, as chairman of the Federal Reserve, began to raise and significantly raised interest rates, which kept the recession going, kept it going until the 1980s. But interest rates came down and inflation came down. And during that time of the early 1980s, companies became lean and mean. Their profitability began to soar. And of course, we entered this period of time of that long secular bull market. From 1979 to 2000, this bull market grew at an average of 17% per year compounded. 79. That was what was happening during that period of time. That was coming out of that inflationary period of time. But where are we now? We're back on that curve that started in the 1960s and continued to roll up to double-digit inflation. Wasn't dealt with, and I believe that we could be entering the same time. We're seeing the same curve. We're seeing inflation begin to tick up little by little, but growing more rapidly. And during that period of time, from 1962 to 1979, the dollar lost 70% of its purchasing power. If you're living on $150,000 today, after the dollar loses 70%, that's like living on $50,000. It's taking a 2/3 whack of your net worth, 2/3 whack of your income. It has a dramatic impact. Now is the time to begin to prepare and to have an excess of net worth to deal with that time. That was a period of time, 1966 to 1982, that if you'd gone away in 1966 and come back in 1982, you'd say, gee, the stock market was flat. 1966, it was 1,000. 1982, it was 1,000. But it didn't. It went down 20%, down 30%, down 40%, down 20%. 4 times it went down. But it was a very difficult time because the dollar and the purchasing power of the dollar lost 70% during that time. Can't make it up in stocks. Can't make it up anywhere else. Anyway, that brings us to an end for today. Take care. Have a good week. And I will be back next Saturday, because if it's Saturday, we're talking about money. That's next week. Stay with me. Stay healthy.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams, here on AM 1590. The Answer. The preceding program was sponsored by Adams